Have you ever wondered why the market or a stock seems to move in a certain pattern, exhibiting phases of expansion and contraction? Well, sit tight because today we're delving into the intricacies of these two fundamental market phases. Firstly, let's unpack the expansion phase. Picture this. The price of a stock is trending in one direction and the daily range is significantly wide. This movement, think of it as a dance, is led by active participants. These are the individuals who come in with a strong conviction, ready to push the price to new heights or plunge it to new depths. They're like gamblers who aren't afraid to place higher bets because they believe they're on a winning streak. Or they might be willing to sell their stocks at lower prices, predicting that the price will drop even further. If you were to plot this on a graph, you'd see the price highs and lows confined within a clear band, sloping either upwards or downwards. This phase is all about direction and momentum, fueled by these active participants. Their aggressive buying or selling action propels the price far away from the mean value. But trading in such markets requires specific techniques. It's a bit like surfing. You have to catch the wave at the right moment and ride it until it ends. This is the essence of the expansion phase, where trending moves and expansion go hand in hand. Now, let's shift gears to the contraction phase. Imagine a market where prices are moving in a tight range, like a car stuck in a slow-moving traffic jam. This phase is driven by reactive participants who lack the conviction to push prices beyond a certain level. These participants are cautious, unwilling to pay higher than their perceived price for buying, and equally hesitant to sell the stock at lower levels. As a result, the price movements are limited in size until the range is broken. There's a tug-of-war between supply pressure at the upper end and demand pressure at the lower end, but not enough to push the prices outside their comfort zone. This is the contraction phase, where a ranging market and contraction go hand in hand. Now, it's important to remember that the market doesn't stick to one phase indefinitely. It alternates between phases of contraction and expansion, like a pendulum swinging back and forth. A contraction phase or a ranging market is usually followed by an expansion and then again by another contraction. It's the market's way of taking a breather after a trending move before gearing up for another one, whether in the same or in the reverse direction. So, there you have it, a comprehensive look at the two market phases, expansion and contraction. Understanding these phases can give you a clearer picture of market trends, helping you make more informed trading decisions. So the next time you see a stock price moving in a certain pattern, you'll know whether the market is taking a deep breath or getting ready to sprint.